Good morning, everyone, and a very warm welcome to our Finance Focus webinar. We are delighted to have so many of you join us today. I'm Jennifer Williamson, I'm a partner at Creston Reeves, and I'll be chairing our session today. So for those of you who don't know Creston Reeves, we're here to help our clients with so much more than just accounting, business and wealth advice. We support you in achieving your ambitions so you can reach your brighter future, which is in times of rapid change and increasing complexity, staying ahead of the curve is more important than ever. So today we've brought together a panel of experts to provide you with some timely updates and practical insights across a range of key areas and to answer any questions you might have. So I'm just going to start with a little bit of housekeeping. This webinar is being recorded and a recording will be sent to you all later today. IT permitting, we'll be asking for a bit of interaction throughout the presentations by taking some polls so we can share the results with you and generate some further discussion. And finally, there will be a pop-up survey at the end of our session today, and we would be really grateful if you could just spare a few minutes to provide us with some of your feedback. Now, before the session today, we've already had some questions sent in, but please do continue to submit your questions throughout this webinar using the question functionality shown on screen, so that when we get to the end, we can answer those for you. Just going to leave that there for a moment whilst you familiarise yourself with the function. And as I said, we will come to your questions after our panel have presented. So we're going to be spending the next hour or so updating you on recent or upcoming important changes to keep your technical knowledge of the ever-changing regulatory landscape up to date. We'll be followed by a Q&A session where you'll have the opportunity to have those questions you're populating answered by our presenters. The areas we'll be covering for you today are beginning with a macroeconomic overview to frame the broader context in which businesses are operating. From there, we'll explore the financial implications of rising employment costs, including changes to national insurance and minimum wage. We'll then turn to the corporate tax landscape, examining both recent developments and upcoming reforms, and that's going to be followed by a practical look at the evolving R&D tax relief scheme and how businesses can continue to benefit from innovation incentives. And finally, we'll conclude with a forward-looking discussion on financial reporting and the future of audit, helping you stay ahead of those regulatory shifts. So to introduce our presenters for today, we have myself as chair, we have Andrew Tate, our restructuring partner, Mohammed Mujtaba, one of our corporate tax partners, as well as Sam Jones, another of our corporate tax partners, Peter Manser, one of our audit compliance partners. So next I'm going to pass over to our restructuring partner, Andrew Tate. He will talk you through the impact of employer national insurance contribution and minimum wage increases. Over to you, Andrew.
Thank you very much, Jen, and good morning, everybody. Very pleased to be here. As you've heard from Jen, I'm a restructuring partner. That means I'm an insolvency practitioner. And I would say that people in my profession, there is a bit of a tendency to over-dramatise economic events. This is dreadful, you need to come and talk to us. I don't subscribe to that. Things like the tariffs that Patrick talked about are scary, but these are all events and bumps along the way. And I take it that the audience that I'm talking to is quite experienced and takes things in their stride. So this is going to be a short session just highlighting some of the strategies which have been adopted by some of our clients in relation to the national insurance increases which were announced last year. I'm going to concentrate on these more than the minimum wage. Minimum wage did increase last year, and that was 10% for most employees and even higher percentages for younger employees. But I'm going to concentrate on the national insurance, and we would be very interested to hear any questions that you have or your experiences via the chat. So if we just move on to the next slide. Just as a very quick reminder, the increases were announced in the autumn budget last year. The national insurance rate for employers' national insurance went up to 15%, and the threshold where employers' NIC is payable reduced to £5,000 from £9,500. There is the higher employment allowance, which was increased at the same time, and that is a maximum of £10,500 for a business. So it's a fairly small impact, and not necessarily something which is going to make wholesale changes for the business. So if we could just move on to the next slide. So what mitigation strategies have been adopted, and really here in this first part of the slide, I'm looking at the people costs, which is obviously where national insurance impacts. So I haven't put on the slide, but it's fairly obvious, reducing headcount. Whether that's via natural churn or redundancy, can be a way to reduce the national insurance impact and the cost to the business, and also obviously a freeze on hiring, which can have the same effect over time. But looking at the people costs, really on the left-hand side of the screen, we refer there to a pay freeze. Clearly, a pay freeze for employees is one way for a business to contain its costs in this respect. Clearly, as Patrick was saying, with inflation sort of pushing back up again, that could be quite difficult to land with employees. And I suppose there's a couple of further thoughts there. One is that there might be a freeze on pay banding. So if you use banding for your employees at different levels, you could actually freeze the banding so that actually over time, employees will perhaps hit the top of a band more quickly before they move on through a promotion into the next band. So that's perhaps a way to soften the blow, but to still bring it into effect. And the other aspect is lower salaries for new starters. So effectively sort of rebasing the salaries that you pay for new starters. Clearly, you've still got to attract good people into new positions. But it's a strategy that we have seen people exploring. On the right-hand side, we've got salary sacrifice options, which clearly, where there is salary sacrifice, in some cases it can reduce the national insurance impact. So we've got pensions there, being more generous in terms of sort of pension allowances, and allowing employees to save more. Can help, and things like electric vehicles and cycle to work scheme can also help with this. We have seen electric vehicle schemes actually really develop over the last few years. They used to be quite onerous, and we understand that there are more options available now. So these are strategies that could be adopted. What I would just say, just a bit of a health warning, is obviously alongside potentially reducing headcount or these other measures that we're talking about, there are also moves to strengthen employee rights through legislation, strengthening the unfair dismissal legislation, and strengthening the ability of trade unions to be involved in negotiations. So just moving on to the next slide. So other strategies that could be considered here, the obvious one is price increases. It's easier said than done in some industries, and obviously, as I say, Patrick referenced the inflation rate pushing upwards. So it's definitely a tougher business environment, but a price increase, passing on that increase to the the customers is the classic way in which businesses are trying to deal with the national insurance increases. Productivity increases, obviously this is a win-win. If you're able to get more productivity, potentially through the increased use of AI, then certainly that is a win-win for businesses and will help all round. I've put offshoring on there. I think offshoring is still a very, very strong strategy adopted, which obviously in a UK national basis would reduce the impact of national insurance, but clearly there are other considerations to take into account when considering offshoring and what the long-term benefit of that is. And then I've put down hybrid working as well, continuing on the theme from the pandemic. Reducing office overheads is a strategy. We see various businesses trying to get people back into the office and don't agree that hybrid working is the way forward. But again, it is an option. And then at the bottom of the slide, I've just put in there, consider pay strategies, distributing profits other than through payroll. If, for example, you had a family business with many family members in it, that is, again, a consideration rather beyond my abilities to go into that in detail, but I'm sure our tax colleagues would be very happy to help with that. So I think from my point of view, I'll leave it there. There was one thing I was just going to mention, which is that if businesses are starting to fall behind with payments to HMRC, one thing that we have seen a real increase in is the HMRC using a tool called a request for security. We've seen them using this quite a bit, and actually these, if you see any of these coming through or you hear of them, they really need to be taken very seriously. They are a demand by HMRC for upfront payment in advance of, for example, a VAT quarter or a payment in advance, and actually they can carry criminal liability if they're ignored. So just to mention, we've seen an increase in that, and that's something to look out for. Thank you, Jen. Back to you.
Thank you very much, Andrew, for those insights on what businesses can do to mitigate those changes, and also that request for security piece. That's important to know. So we'll just move on to our first poll, which will appear on screen in just a moment. There we go. Which of the following 2024 autumn budget tax changes poses a greater challenge for your business planning in 2025? Is it employer national insurance increase? Is it the capital gains tax increase? Is it both equally, or neither of those are not applicable to you? I'll just leave that there a moment for as many of you to give your responses as possible. I think I know where this is going to land. Yeah. Okay, well, we're getting a few more answers here and there, but the overwhelming majority is on the employer national insurance, as we would have expected. It really has had a big change and a big impact for businesses. Okay, thank you very much for your contribution, everyone. Okay, just a quick reminder back up on screen for you to keep submitting those questions, which we'll come back to at the end when our panel rejoin us. So next, I'm going to pass over to Mohammed, who's going to be discussing corporate tax updates and the upcoming changes on the horizon. Over to you, Mohammed.
Thanks, Jen, and good morning, everyone. So today we'll begin by looking at interest rates and some of the things to look out for from a tax perspective. Later, we'll consider some developments in the international space. So diving right into the first part, interest rates. In last year's budget, HMRC announced that late payment interest on most taxes would be increasing. The objective would be to encourage timely tax payments and ensure fairness for compliant taxpayers, being part of a broader strategy to reduce the tax gap and improve public revenue collection. So on the next slide, we've got previously the interest rates on late payments were equivalent to 2.5% plus the Bank of England base rate. This is now 4% plus the base rate. Rather unfairly, the repayment or credit interest remains unchanged at 1% below base rate. So current rates are there for 8.25% and 3.25%. For those businesses that pay their taxes in quarterly installments, or QIPs as they're collectively known, that rate has also increased by 1.5% above base rate to 2.5% above base rate. So it's currently 6.75%. So what does this all mean? Well, interest rates have increased substantially since 2022, although they've reversed slightly over the past year or so, as mentioned in Patrick's session earlier. So on the next slide, we can see this change reinforces that historic increase and keeps the cost of any unpaid liabilities relatively high for longer, with potential late payments continuing to attract a significant penalty in real cash terms. What this means is it's worth revisiting forecasts to ensure any liabilities arising are provided for in good time, especially where businesses settle their liabilities under QIPs, as mentioned previously. In addition, we've seen instances in the past where cash-constrained businesses were willing to agree payment plans with HMRC, since a loan from an external lender would likely have been more expensive. That situation is now less clear-cut. And obviously, just referring back to what Andrew mentioned earlier in his section, HMRC are sort of more active in this area in pursuing outstanding debts. And finally, where complex transactions take place or inherent complexities exist, it's important to ensure that the correct tax treatment has been adopted and the tax liability provided for, as otherwise the cost is now that much more higher. This is likely to increase the administration and compliance burden in terms of the time and fees that businesses incur. So moving on to the next section, corporate interest restriction. So briefly, the CIR rules limit the amount of tax relief UK companies can get in deducting interest and other financing costs, either individually or as a group of companies. And although the calculations and the rules are relatively complex to determine the restriction, broadly speaking, there's a £2 million de minimis for a 12-month period. Where interest is in excess of this amount, then broadly any deduction for tax purposes in a period is restricted to 30% of tax EBITDA or the group's interest expense on external debt, with the total UK deduction capped to the net external interest of a worldwide group. So what's important to note is the deduction on the interest that is not allowable in a period is not essentially lost, but it's deferred and carried forward to a future period where the group might have some of this capacity to take a deduction, whether it falls below the £2 million de minimis on the interest in that period, or the group ratio is higher, etc. Then it can take this interest as a deduction in that later period. So the rules come with an administrative requirement to consider the relatively complex rules and file appropriate returns alongside the annual tax returns. What I would mention is there is an ongoing working group that is reviewing these administrative requirements and the burden. So let's see what that brings. So what does this all mean? Well, interest rates rising mean that the £2 million de minimis limit will be breached quicker, and therefore likely more businesses will be subject to the restriction, or at least need to consider the rules. If the disallowance occurs, because the interest is higher, the disallowance is likely to be larger, and therefore it will accelerate tax payments by virtue of higher taxable profits. Therefore, it's vital that businesses or groups that are highly leveraged review their tax affairs, particularly those within infrastructure and capital-intensive industries. So moving on to the next section on withholding tax. So generally, the default position in the UK is that where UK companies pay interest, they are obliged to deduct or withhold 20% of the interest payment and pay this over to HMRC, alongside a quarterly filing obligation that has to also be met. There are certain instances where this obligation can be reduced or completely eliminated, such as if the interest is paid to another UK company or a company within the charge to UK tax, or if paid overseas to a resident in a country that has a tax treaty with the UK that allows for a lower rate of withholding. So how does this impact businesses? Well, with the rising rates, simply put, the interest payments are similar to the CIR, likely to be larger, and therefore the withholding tax suffered is likely to be higher. Going back to the reduction or elimination of the withholding tax under a double tax treaty, this would require specific direction and agreement with HMRC prior to making payment to ensure the lower rate applies. However, what we often see is that relevant paperwork is not in place prior to making these payments, meaning that historic issues can arise where many years of withholding tax has not been paid over, and therefore it results in significant interest for late payment, because what we've observed historically is that HMRC will not pursue the principal payment or the withholding, assuming the relevant paperwork can be completed after the fact, but they will pursue any late payment interest as they've suffered a cash flow disadvantage. So coming back full circle, this will be compounded further by the recent increase in interest rates, as Patrick's section also alluded to. So that's the interest rate section. So moving on to the international aspects, the base erosion and profit shifting, or BEPS project, originated from the OECD and G20. It aims to ensure that profits are taxed where economic activities generating the profits are performed and where value is created. As part of this, a number of actions were agreed to target what is seen as international tax avoidance. The UK has introduced two recent changes for some of the largest companies, being those groups with consolidated turnover worldwide in excess of 750 million euros, resulting in an increase of the compliance burden for these groups, which I'll touch upon shortly. So the first change is transfer pricing related. Very briefly, the transfer pricing rules are a set of rules to ensure that transactions between related parties occur on arm's length basis. That is to say, in simple terms, the prices are set as if set between unrelated parties transacting. As is the case with tax most of the time, the rules are complex and there are exemptions from the rules, such as mainly for an SME. So for accounting periods beginning after the 1st of April 23, there are enhanced transfer pricing documentation requirements in line with the OECD guidelines mentioned earlier, to essentially maintain what's called a master file and a local file, as well as a summary audit trail or SAT. Without going into too much detail about the content of these various documentation, the master file provides a high-level overview of the group, its operations, transfer pricing policies, and allocation of income and economic activity. Generally, we see it being maintained by the parent entity, and then the local file contains detailed information on material intercompany transactions of the local entity, so in our case, the UK entity or entities. So what does this mean for businesses? Well, the documentation must be ready by the time the tax return is filed, and if requested, must be provided to HMRC within 30 days, or there is a risk of fines. This will lead to an additional compliance cost and administrative burden for these businesses going forward, where there wasn't specifically anything within the prescribed rules by HMRC to maintain this documentation. It was just a requirement to maintain transfer pricing documentation, which remains in place even for those groups that are below the 750 million turnover threshold. So moving on to the final part, we have BEPS Pillar 2. So what this does is it introduces a minimum effective tax rate of 15% on profits in each jurisdiction where these international groups operate that exceed the £750 million turnover threshold. The minimum tax rate is to be policed by way of two pieces of domestic legislation in the UK that work in tandem but with different targets. And these are being replicated in other countries who have signed up to this as well. So the multinational top-up tax, or the MTT, will impose an additional top-up tax on UK parent companies who have interests in entities in territories with an effective tax rate that is below 15%. By doing so, it will bring the overall effective tax rate of the group to 15%. At the same time, the domestic top-up tax, DTT, will impose an additional top-up tax on the UK companies, so non-parents, to ensure that the effective tax rate is 15% in the UK where those companies are paying a lower rate of tax. This looks to minimize the tax leakage from the UK where the effective tax rate is below that 15%, so that other territories where the Pillar 2 rules are in place do not obtain essentially that tax benefit. And the rules apply for accounting periods from after the 31st of December 23. So what does all of this mean? Businesses with operations in multiple jurisdictions, and particularly those where the local tax rate for businesses is lower than 15%, will need to be careful. There's a potential for additional liabilities where operations exist in low tax rate jurisdictions with a commercial decision as to whether to continue to operate in those territories with the additional tax burden. At a minimum, there will be an increased compliance burden going forward to quantify the impact of the rules on the group. The complexity means that the additional risk of non-compliance and penalties. And ultimately what this means is that it's important for businesses and international operations to review their position worldwide, since the rules will be replicated in a number of countries. And with that, I'll hand back over to Jen.
Thanks very much, Mohammed. There's such a lot in there, isn't it? I'm sure it's going to give us some questions for you to answer later on in the session. So next we're going to move on to research and development and patent box, and that's going to be explored by Sam Jones. So I'm going to pass over to you now, Sam.
Thank you, Jen. Right, good morning, everyone. As Jen mentioned, I'm here to talk about R&D tax credits, and I'm also going to touch on the patent box. So R&D has been a hot topic for the last couple of years. Not only has there been changes in the rates, changes in the schemes, changes as to what can be included, there's also been a lot of HMRC scrutiny. So let's look at what scrutiny we've been seeing. So we've been seeing a rise in the claim of R&D inquiries, and that's jumped up to 1 in 5 R&D claims being under review. And that's because HMRC estimate that there's fraud and error in the system of up to 1.1 billion. But that could have been due to rogue advisors and fraudulent claims. But what we've also found is actually when clients have had an inquiry, the costs of those inquiry has been more than potentially the tax saving that perhaps they've got from their R&D tax credits, or perhaps they haven't had the time to defend those claims, and therefore they have just potentially removed those claims from their tax returns. So we've seen that the defence costs can cost up to tens of thousands of pounds. So we'd recommend that any of you that have your R&D tax claims prepared by us and we submit your tax return, that you consider our tax investigation service. So try and minimise the risk of fraudulent claims. HMRC have put in a lot of additional checks. The first was introduced in August 2023, which was that all claims must be supported by additional information form. So this information form includes full details of the claim, details of the projects with a set number of projects needing to be included, covering a percentage of spend. And it's a way for HMRC to assess the claim that's been submitted and also the agent submitting the claim. Most of you will know that generally when we prepare an R&D tax credit claim, we always prepare a full report to support that claim, and we still recommend that that's the case. Another thing that they've brought in is some additional notification forms, so an advance notification form, to make sure that they know who is due to be making a claim, and that's relevant for new claimants. And a new claimant is anyone who hasn't made a claim in the last 3 years. And I'm going to talk about that more on the next slide when we get there. So there is also a portal for voluntary disclosure that's been open since January 2025, which allows the taxpayer and agents to notify HMRC if they think they've made a claim in error. If you did make a claim in error, then you would need to pay back the tax, and there'll be interest on that and potentially penalties, but that could be reduced if we've made a disclosure as opposed to HMRC inquiring. So let's look a bit more about the advance notification form. So the advance notification form has come in for accounting periods starting on or after April 2023, and it's really relevant for new claimants or those who haven't claimed in a while. If you don't make this advance notification, there won't be a claim available to you after that date. So if we look at the example here, we've got December 2024 year end, and they need to make an advance notification to HMRC by June 2025 if they haven't made a claim. If you have made a claim in previous years, you look at a 3-year period from the date of the notification date, so June 25, back to June 2022. So if you've got any question over whether or not you meet that requirement, you should reach out to advisors and we can advise. There's some caution here. If you've got a long period of accounts, so a period straddling that April 23 date when the rules change, you could end up with 2 tax returns because you're preparing a long return, and therefore one of those periods might need to notify, and it's quite easy to miss it. And also, if your R&D claims have always been included in amended returns, it's also easy to miss. Okay, so let's talk about how we can help you. So at Creston Reeves, we have a dedicated R&D team to help minimise risk of inquiry. So we are able to review any of your claims before we submit them to HMRC to make sure that they're compliant. We can also just have a conversation with you about what's changing and provide you some guidance and support. We tend to price our support by a risk-based structuring as opposed to quantity of spend. So rather than some of like a percentage of tax saving, we tend to do it based on the risk of your claim. And also we can offer this tax investigation service, which if you've got an inquiry, will cover the cost of our fees. We like to tailor our approach based on how it works best with you. So we can either do a high level review of third party claims, which is called PCRT. That's just our professional ethics that we have to meet. We could also work collaboratively with you. So you might choose to prepare the numbers and the project descriptions, and we'll work with you to make sure that claim is as robust as possible. We put it in an R&D report format and prepare the additional information form that I mentioned earlier. Or we can do what I call the Rolls-Royce service, and we can do everything. So we can come in, we can interview your technical individuals and make sure we prepare the full claim from that interview and work with your finance team to prepare the numbers. Okay, so let's move on and look at what has changed. So recent changes to R&D schemes. So I'm started off by saying lots of change with R&D. So not only have the rates changed, there's also new schemes. So for accounting periods before April 2024, we're within the SME scheme that we've all known and loved, which the rate has dropped to 86%. And we've got the RDEC scheme, which is more for large corporates or those SMEs that perhaps are grant funded. But from April 2024, there's going to be a new regime. Majority of companies will be within what we're calling the merge scheme, which will look very much like the RDEC scheme we have currently. But there's also an enhanced R&D scheme for R&D intensive companies, which protects the value of that claim. So let's move on and look at some numbers. So we've got here a March 24 period end, and if you were an SME, you would be still within the existing regime, which allows you to get an 86% uplift on your costs. So if you had £100,000 worth of spend, you get an additional deduction in your tax return of £86,000, which overall results in a tax saving for a profitable company of 21.5% of that £100,000 spend. If you're a loss-making company, you're able to surrender all of that R&D tax credit, so the full 186% to HMRC for a 10% tax credit, which results in a 18.6% subsidy. The RDEC scheme has a headline expenditure credit rate of 20%. However, that credit is ultimately taxed. So that relates to a 15% tax saving on your R&D spend. And if you're loss making, you can surrender that tax credit to HMRC for a cash-free payment. The R&D intensive scheme is already in place, and if you're deemed to be R&D intensive if at least 30% of your spend is R&D related. However, you have to look at your whole group in determining whether you're an R&D intensive company, and it can be a little bit complex, so please do reach out. This is only available for loss-making companies, and it allows you to get an increased tax credit of 14.5%, which ultimately means it's more valuable and you get up to roughly 27% subsidy on your R&D spend. That's really been lobbied by those innovative early stage tech companies and bioscience companies to make sure that R&D is still key and is staying here in the UK. So moving on to April 24, we're seeing that there's going to be a merge scheme. Sorry, back one slide. Going to be the merge scheme, which, as you can see there, pretty much mirrors the current RDEC scheme. So the RDEC scheme rate was increased up to 20% previously before March 24, and therefore you get a effective 15% tax saving. And again, you can surrender that if you're loss making to HMRC. But because there's two CT rates at the moment, you can get relief up to 16.2%. And that R&D intensive scheme is still there for those R&D intensive companies, resulting in a repayable tax credit of around 27%. And the only other thing that's changing from April 24 is that overseas subcontractors and externally providers will generally no longer qualify unless the work cannot be undertaken in the UK due to geographical, environmental or regulatory reasons. It's a very tight, narrow definition. So those of you that might be subcontracting overseas because it's cheaper to have an overseas subcontractor, those costs will no longer qualify. So what are the key takeaways from all of the changes that we're seeing in the R&D landscape? We would recommend that you provide a robust supporting documentation to HMRC. So that would be preparing a full R&D report, which sets out how you've prepared your claim, any assumptions you've made, full details of your project and how those numbers have come about. I would recommend that everybody has a look if you're wanting a new entrant to a claim, that you don't miss this 6 months to notify HMRC. Or if you've got any doubt as to whether or not you would qualify, please reach out and we can have a look for you. Those of you that are now moving into the merge scheme, you might want to know, well, how does this impact the amount of qualifying, well, not so much qualifying spend, but how much tax relief you're going to get? Again, it's worth reaching out and we can let you know how much that might impact your claim. So for my final slide, I'm just going to touch briefly on patent box. So you've done all your R&D within your company, and you've been able to protect your IP in the form of a qualifying IP rights or a patent. So there's actually a relief that isn't as widely used as it should be, which allows for a reduced 10% corporation tax rate on profits resulting from exploiting that qualifying patent or IP. So how can you qualify? So you need to have a qualifying IP right. So generally that is IP which is patented in the UK, and there is some grandfathering from the EU rules, or you could hold an exclusive license to exploit that patent. In addition, there's a development condition. So as long as you have developed that IP in-house or within the group, then you should be able to qualify for this relief. It doesn't work where perhaps you've just purchased IP for you to use in your projects. The calculation is based on a streaming calculation, and what you need to do is identify all of the income from that qualifying IP, and that relates to the whole product, not necessarily just that patent. So if that patent is embedded into a larger product, you would pull out all of the income and expenditure from that patented IP stream, and then you would put everything else in the non-IP stream. And then you do some calculations to remove things like a routine return, which is effectively 10% of your overheads. You also exclude profits relating to marketing assets, which is pretty much removing brand value. What we have found is most of the clients we work with, that number is extremely low. because your brand value is not something like Apple, for example, where we buy that product because it's Apple. So it's definitely something to look at. And then there's a few more calculations, and ultimately it results in an enhanced deduction that reduces your taxable profits and gives you this effective tax rate. So I definitely would recommend, if you've got IP and you've got patented income coming through, that you reach out and we can see how that might impact your tax return. Sometimes in the early stages of the patent box, if you're making a patent box loss, it's not worth electing into the scheme until you know that you're making profits from that patent. So that's all from me, and I'm going to hand back to Jen.
Thank you very much, Sam. There's been such a shift in attitude from HMRC to R&D, hasn't there? It went from them worrying that businesses weren't using the relief enough to now a really high level of scrutiny. So thank you very much, Sam. We're just going to move on to our second poll for the session. I'm going to ask you about your own R&D position. So are you looking to make a research and a development tax credit claim? Yes, no, or we're not sure we qualify? Okay. So quite a number of people are no, and that may be because you know you don't qualify, or maybe what Sam said has made you think it's not worth it. Still a high proportion saying yes, and a number saying you're not sure. So it would be interesting if we can see if we can help you understand whether you will qualify or not. Thank you very much, everyone, for casting those votes there. So just a quick reminder, keep asking those questions throughout these presentations, and then we will be coming to answer them shortly. But lastly, I'm going to invite Peter Manser back to join us, who's going to be helping you understand the latest financial reporting and the future of audit. Over to you, Peter.
Thank you very much. So in this section, we're going to look at financial reporting. And of course, this is very much key to all the topics we've been discussing so far this morning, as the accounts, the financial statements drive the tax and other people's consideration of our solvency and our future. So moving on to the next slide then, we're going to consider current issues in financial reporting, and these break down into two broad sections. Firstly, what is changing actually in financial reporting? How will the accounts change in the future? And just a brief overview of company law reforms and how they impact companies. So let's look at those financial reporting changes then and see the detail of what's coming in the future. So just to remind ourselves about the UK accounting framework that we have. So we have a suite of financial reporting standards known as FRS, and you'll see here that the overarching principle is contained in FRS 100. And then we have standards 101 to 105. And then alongside the UK accounting standards, we have the international financial reporting standards as adopted here in the UK. Now it's important to recognise that the IFRS are part of the suite of accounting standards that are available to UK companies. So FRS 105 is for the smallest of our entities, the micro entities as they're known. FRS 4, 3 and 1 all deal with specialist industries or specialist situations. But it's FRS 102 that we'll be concentrating on this morning and the upcoming changes to that. So moving on to our next slide, we'll see some of the changes that are coming there. So FRS 102 is the principal standard adopted by most companies here in the UK who do not adopt IFRS. IFRS is available to everybody and is mandatory for the large listed companies. And some companies volunteer to adopt this because they're part of an international group and it aligns their reporting with other members of the group. But they're developed for very complex situations, so most companies adopt the simplified FRS 102, but that's heavily influenced by IFRS itself. So when we talk about changes to FRS 102 and why, the primary driver is what is happening to IFRS. And we'll see that we'll be adopting within FRS 102 some key changes which are driven by what's already happened within IFRS. So what has changed? Well, there's been a number of changes that are coming up. Principally, we'll see that there are two areas, that of how we account for leases and then also how we account for revenue as well. So we'll be concentrating on these two key changes. When do they happen? Well, it's mandatory for accounting periods beginning 1st of January 2026. So if we take a December year end, so 31st of December 2026, these changes will be mandatory and would have to be reflected in accounts from then on. So we still have time to understand these changes and prepare for them, and then understand what the implications could be and how we can mitigate those. So let's explore these two key changes further then, leases and revenue recognition. Moving on to the next slide then, we see that we have accounting for leases. So very simply saying that where we have a lease, the change will mean that the asset and the corresponding liability will appear on the balance sheet. So in principle, in essence, a very simple change, but a very key and fundamental change. If we have a lease, then that corresponding asset will have to go as an asset on our balance sheet, and that asset will be balanced by the corresponding liability. Now, contrasting where we are currently, we now look at the leases and decide whether it's an operating lease or a finance lease. If it's a finance lease, where essentially all the risks and rewards of ownership of the asset are taken up by the lessee, then we already recognise that lease, asset and the liability on the balance sheet. But for many, many assets, we treat them as an operating lease. So we just expense the lease payment and we don't recognise the asset or the liability on the balance sheet. And that's the key fundamental change. That distinction between operating leases and finance leases will no longer be relevant. All leases will be accounted for by putting the asset and the liability on the balance sheet. So of course, when you stop to reflect, you can see how the balance sheet could, for some companies, look very different in the future. What about the impact of the profit and loss account? Well, currently we expense the operating lease payments as the lease payments as they're incurred. That will be replaced by depreciating the asset that is on the balance sheet. So the depreciation charge will go through the profit and loss account as an expense, and the interest element of the lease payment will be recognised as an expense through the profit and loss account. So the two key primary statements in financial statements will be changing quite significantly where companies have lots of operating leases currently. So a big change coming that we need to understand. Moving on then to our next slide. How significant is this change? Well, as I explained, this change is really being driven by what's already happened with IFRS, the International Reporting Standards. So we can now have the benefit of how were companies impacted when IFRS adopted this model of putting all lease liabilities on the balance sheet. And you can see from this slide that it had a very significant impact on certain companies and certain sectors as well. So if you operate in a sector that is very asset heavy and you have a lot of leases, this is going to affect you quite significantly. So take, for example, Tesco's, obviously a huge company here in the UK. They had to put an extra £10 billion of lease liabilities on their balance sheet. That meant their reported debt went up by 50% and their assets by 20%. So their balance sheet, when they adopted this standard, changed very significantly. And we see that in particular sectors, retail, for example, airlines, which often lease a lot of their assets, travel and hospitality, where they often perhaps rent premises. So quite a significant impact on certain sectors and individual companies. Moving on then, on to further reflection. What are the exemptions? I said at the beginning that all assets will go. Well, that's not quite true. There are two key exemptions. One is low value assets, and the second one is short-term leases. Now, low value assets introduces another level of judgment in preparing our financial statements because no monetary value has put on low value assets within FRS 102 revised. Now, to give you some background, the international standards, when they were being developed, they spoke about a monetary value of $5,000. So that gives us a feeling for what's being looked at. But this is an individual judgment that will have been made. So we might take the view that laptops, phones could be classified as low-value assets, but clearly vehicles, vans, lorries, cars, they would not be classified as a low-value asset. Short-term leases, well, that's much more clearer. 12 months and shorter will be a short-term lease and can be exempt from these requirements. So we won't be accounting for the asset and the liability for short-term leases, 12 months and below. So two key exemptions that we have to understand. The first one, low-value assets, very much a judgment. The other one, short-term leases, is 12 months or below. Moving on then. Let's look at the implementation of this. So we have a phrase here taken from the accounting standard, which tells us that on implementation, we have to recognise the lease liability at the present value of the remaining lease payments. So when we start talking about present values of future cash flows, we can see straight away that there's a calculation involved in recognising the liability that we have to recognise on the balance sheet on implementation. So this involves another key area of judgment is what discount rate will we apply in calculating the present value of those future payments. And again, there's some guidance on that within the standard, but again, it's a matter of judgment. So when we have these key matters of judgment, it's really important if you're audited to be speaking to your auditors to understand where their judgment would fall as well, and make sure that we have a uniform approach in preparing financial statements for audit. The discount rate and the period of lease, for example, are key matters to identify. So depreciation then on implementation. If there's no essential certainty that we're going to obtain ownership of that asset at the end of the lease term, then we have to depreciate that asset over the shorter or the remaining period of the lease term and its remaining useful economic life. So we could have an asset with a very long economic life, but the lease is quite a short period coming up, in which case it would accelerate depreciation quite significantly. Now, on implementation, this is what we're talking about on this slide, there is no restatement of the comparatives. So there's a big bang on day one. We prepare our balance sheet under the new principles. The balance sheet will have comparatives, which will be still on the existing basis. So we will end up with a situation on implementation where the new balance sheet could look quite different to the comparative balance sheet. So that's no choice in that matter. That's what's been decided. And the cumulative effect is recorded as an adjustment to the opening reserves to make sure the balance sheet still remains balancing. So that's implementation of accounting for leases then. Not much choice, clear direction as to what has to happen there. Moving on to the next slide then. Let's think about some of the challenges with regard to accounting for leases then. The first one is the obvious point, is that we need to do an exercise to identify all the leases that are operating within our business. This might seem quite straightforward, but of course we could have quite old leases that are still running, so we need to make sure that we get the documentation in place for that. We need to make sure that we record the key terms of this documentation. But we also have to look out for any services that we're buying on a regular basis where there's perhaps an embedded lease built into that contract for services, in which case we'd have to consider recognising that lease liability as well. As part of the challenge, what I've spoken about, we have to determine the discount rate that's applicable, and that's really a matter of discussing with your advisors to make sure that you're aligned on that. And then we have to perform the calculation. So quite a lot of work, and we may want to understand the impact upon our balance sheet. So now's an opportunity to gather that information, do the calculation, and see the impact it's going to have on our balance sheet, and perhaps start communicating with those that rely upon our financial statements. So that's accounting for leases then, and the challenges that arise. Moving on to the next slide. The next key challenge that's coming with a revision to FRS 102 is how we recognise revenue. And we've spoken before in these sessions about the adoption of this 5-step model, which again comes from the International Financial Reporting Standards. Now, this 5-step model that's adopted here for the UK FRS 102 accounting standard is a somewhat simplified version of what appears in the IFRS. So the 5 steps then, we have to identify the contract. We then look within the contract to understand what the actual performance obligations are, determine the transaction price, and then allocate that transaction price to the individual performance obligations. Now, in a very simple contract, there may be just one performance obligation, very straightforward. But in many contracts, when we start analysing them, we see there's a whole series of performance obligations where the transaction price has to be allocated against the individual performance obligations. And then the final step is we actually recognise revenue when the entity satisfies that performance obligation. So applying this 5-step model in certain complex situations where the contract has a number of obligations can result in a very different profile of how we recognise revenue over time from a contract. So moving on, let's consider the impact on this then. Again, we can look back at the implementation of the principle within IFRS and see how it affected the larger listed companies. And we're told from research that 50% of companies, when they adopted IFRS on this 5-stage process of recognising revenue, had to make a material adjustment to the recorded turnover. Again, it affects particular sectors. So IT, software, construction, where the contract's often quite complex and there's a series of performance obligations over quite a long period of time. These are the sectors that were greatly affected by the adoption of this within IFRS, and we would expect the same when we adopt it within FRS 102 as well. Moving on then. So what is the impact then of this 5-stage revenue recognition process? Well, we've seen that in certain situations it can have a material effect on the financial statements. Revenue recognition is clearly talking about turnover, so our turnover can be affected, and if our turnover is affected, then obviously the profit measure, the net profit, it changes as well. So key measures, the EBITDA, for example, can be quite significantly changed from the adoption of this 5-step process. So some key impacts that we need to understand and make sure that we communicate to those who are reading our financial statements. Moving on to the next slide then. What about implementation then? We saw with the implementation of the lease liability that we've got a clear direction, no choice. Here with revenue recognition, we do have an option. It is possible to restate our comparatives. So we can choose then to restate the comparative figures within our accounts on the same basis. What this means is that readers of financial statements will see last year's figures on the same basis as this year's figures, which would help comprehension and understanding. Or we have the choice, like the lease liability, we can just record the cumulative effect on our opening reserves. So unlike leases with revenue recognition on implementation, we do have a choice as to how we reflect that change in that first set of accounts that applies to. So on to the next slide then. Changes to FRS 102. We've seen that there are 2 key changes. There are a number of other inconsequential changes that we need to be aware of near the time, including extra disclosures, for example. But the 2 key changes to be aware of is how do we account for leases and when do we recognise revenue. And as I say, these start from accounting periods beginning 1st of January 2026. So for a December year end, it will be 31st of December 2026 with the first financial statements prepared, recognising these changes to leases and revenue recognition. So some pretty big changes coming down the line, but we have time to understand the implications and prepare for them. And especially gathering all the documentation, particularly for leases and that analysis of contracts for revenue recognition. Moving on then. So just a Brief overpoint about governance. So we have a key piece of legislation which is being introduced over a period of time, the 2023 Act. The one that you need to be aware of is identity verification at Companies House. This is coming. We're currently in a voluntary window. Who does it apply to? Directors, those who are like directors, and people with significant control. This is expected to be mandatory from autumn 2025. So a key change in our interaction with Companies House and what's on the public record coming shortly. Moving on then, just going back to accounting standards, just an awareness piece about environmental and social and governance changes. So reporting standards here, these apply to the largest of companies and listed companies as well. We expect the impact on SMEs to be quite small. It'd be a voluntary basis for SMEs, but it will affect perhaps the information that SMEs have to supply to their customers if their customers have to apply this. So the FRC have just announced a consultation period on these accounting standards that are coming. They will apply to the largest companies to begin with, but will of course change the reporting environment in which we operate. On to the next slide then. Why would you consider adopting these changes then for ESG if they're voluntary, if you don't apply, if you're a small or medium-sized entity? Well, we're seeing there's a number of reasons why carbon reporting and sustainability reporting is increasingly of importance and relevance. People considering investment, people considering joining your organisation have to consider these things. If you're supplying government departments, you might be forced to produce some of these reports, particularly if you're supplying the NHS, for example, at the moment. And if you're building your business for a future exit, again, that could be important. So it's good to be aware of these ESG reporting changes that are coming later in the year, we expect, applying to larger companies, but how you might want to adopt some of these principles going forward as well. On to the next slide then. So in summary then, what have we seen? We've seen some company law changes where we've got compulsory identification coming, which will be administered by Companies House. That the voluntary window is open right now. Mandatory, we expect, by the autumn. Already in place, we have some company size changes, which were announced back in April. So you need to understand whether you're classified as small, medium, or large. Those sizes were increased by approximately 50%. But then impacting that, we've got the changes to financial reporting, the changes to FRS 102 on leases and revenue recognition, which will change the shape of your balance sheet and also potentially your size as well. So whether you're audit exempt or not could be changed by these changes. And then just awareness about future changes to ESG for the largest companies and how that might impact you if you supply these largest companies. So Jen, back to you, please.
Thank you so much, Peter. We're just going to do one final poll for our audience before we move on to the question and answer session. So coming up on screen shortly will be that poll. So what is your business's main priority over the next 12 months? Is it growing? Is it sustaining? Survival? Merger and acquisition? Or selling and exit? Just let those votes come in. Okay, so the highest one there is obviously growing, quite a number sustaining. I guess in the current economic environment, that's a strong achievement in and of itself. And then a few at the bottom around survival, M&A, and then selling or exit. Okay, thank you very, very much, everyone. That's really useful insights, which we'll reflect on. So final reminder for how you ask those questions is on screen now. I'm going to invite our presenters back on screen so you can see them all. And your questions have been coming in whilst they've been speaking, but please do continue to submit them. Okay, welcome back. Okay, I can see some questions populated on my screen over here already. So I'm going to start with you, Sam. We have our first question in from Maya, and she has asked, with the increased HMRC scrutiny, is it too risky to make an R&D claim?
No, I don't believe it's too risky to make an R&D claim. I mean, there is increased scrutiny, so what I would recommend is we spend a bit of time making sure you've got a qualifying project, we actually prepare a suitable project description to share with HMRC, and we collate all the spend, and we jump through the additional reporting requirements in forms of the AIF, prepare a report, and make sure you notify. But the relief is still really valuable to businesses. I mean, an effective tax rate between 15% and 27% is still valuable for those that are making significant spend on their R&D projects. So definitely think it's not too risky. It's just making sure that businesses who are eligible can claim, and that the money isn't going to the wrong place.
Yeah, and that you register for the scheme in time.
Yeah.
Great. Thanks very much, Sam. Peter, I've got a question for you in next. This has come from Lisa. She asks, what if your lease is rolling? So you're only signed up for a 6-month rolling lease. Your intention would be to have it longer, but it's currently less than 12 months. What's the lease recognition principle there, Peter?
Yes, thank you. Yeah, so we saw one of the exemptions under FRS 102 is the short-term lease, 12 months below. So the question there is about a rolling 12-month one. There's another question here about specifically where leases are set at 12 months and then renewed again. And this is one of the areas of judgment under FRS 102. So it boils down to the intention. So if the intention is that we know we're going to renew the lease, it's a rolling 12 months, we have every intention at the beginning to carry on doing it, then we would have to apply that and recognise the asset and the liability. So some of these leases have been designed probably for that particular purpose. It's really a matter of discussing with your auditors what is the intention, how can we document that, and if the intention is that we're going to renew, then we look through that and we recognise the asset and liability as though it were a longer term lease.
Okay, thanks, Peter. And just to add on to that, I guess if the intention was not to renew and it wasn't recognised, but then minds were changed, is there a requirement to restate the comparatives?
Again, it comes back down to that intention. So if your new intention is that it's going to go on for a period of longer than 12 months, then yes, you would. If the intention is that it's not, and obviously, we need to be aware that this could be abused and it's a matter of judgment. But yes, back down to intention when you're preparing those accounts.
Thank you very much, Peter. So important discussion at that audit meeting. Mohammed, I've got a question for you next. It's coming from James. He asks, would there be any other implications of making late payment of tax besides the interest on the liability that you covered for us?
Thanks, Jen. So I suppose it's tax dependent, and in some cases there are additional penalties. For example, under self-assessment, there's a 5% penalty if payments are made 30 days late. However, no such penalty exists for CT, but there is a wider commercial issue with HMRC chasing for outstanding liabilities and taking any necessary enforcement action for recovery, for example, debt collection or legal proceedings, as briefly touched upon in Andrew's section earlier. Of course, we'd always recommend liabilities are settled on time, and if businesses are having difficulties, they should come and speak to their advisors in the first instance.
Yeah, and I guess if anyone has any legacy issues around it and wants to understand how it might have impacted their credit report, that's something we can help them with. Okay, thanks very much, Mohammed. Andrew, I'm going to pick one for you that we've had come in next. This has come in from Jeremiah. He asks, how long do you think it will take before businesses feel the impact of the employer's national insurance changes?
It's an interesting question. I think actually my reaction would be how long will it take to feel the impact of any mitigation strategies? I think that the impact of the national insurance costs was immediate when it first came into play in April. So I suspect that businesses are already seeing the cost of it. But actually the impact of strategies to manage it really depends on sort of how quickly you need to mitigate that increased cost. So can you pass the increase onto your customers through price increases, or can you do it more subtly by perhaps holding back sort of pay banding, which may take a year or more to come into play.
Yeah, it will be interesting to see as those mitigation strategies come in, how that could have a wider impact on perhaps some of the things that Patrick talked to us about first thing this morning. Thanks very much, Andrew. Peter, I've got another lease question in, which I think you've broadly covered, but just for clarity, to make sure that our audience understand it, it's coming from Harry, and he asks, what is the small lease exemption?
The small one, yes. So again, this is a matter of judgment. So we're looking at the financial value of the right to asset lease, and we're looking at, interestingly, it's not the current value of the asset, but it's the original value. So if you have a high value asset which is depreciated significantly and is now quite small comparatively in terms of value, it will still apply. So it's the original value. The original discussions were talking about a limit of $5,000 because it's an international standard that hasn't been adopted in the UK, and it's described as a matter of judgment depending on the entity. So again, where we have a matter of judgment, I think it'd be good if you're an audited entity to speak to auditors early on to get a feel for what would be acceptable. Obviously, if you have lots of small assets, that's quite difficult to administer and account for. And if we can get those under the exemption satisfactorily, then that would simplify matters. But it's a fairly small number we're talking about as the background. Sort of $5,000 was the original thinking.
Thank you very much, Peter. I'm conscious we're coming towards the end of our session, so I'm just going to ask one more question from our panel. And if our audience have had any questions that haven't been answered today, we will make sure we respond to you outside of this session. So Andrew, I'm going to finish with you. This one's coming from Owen. Do you think there are any particular sectors that will be more impacted by the employer national insurance increases?
Thanks, Jen. I think we are seeing the really retail and hospitality quite hard hit by this. Obviously, with generally sort of low margins, a high number of staff involved in those businesses, that's where we are seeing an impact. I have a particular interest in music, and there have been lots of music retail stores. I would say actually unprecedented, lots of historic music stores closing. And I think in contrast, hospitality there have been some casualties in hospitality, but I think probably we might all agree that actually that's probably where price increases are coming. So we probably see more of a strategy to increase prices there rather than necessarily not being able to pass those costs on.
Thanks very much, Andrew. So I'm going to say thank you to our panel for those insightful answers and discussions. We're going to leave our questions there. If the audience have any additional questions or they haven't been answered so far, or any other matters you would like to discuss further with the team, please just leave a brief description of these in the pop-up survey at the end of the webinar, and we will be in touch. So I'd just like to let you know that on Thursday, this Thursday, we will be holding our second finance focus webinar, but this is for business owners, and it's going to provide an update on recent and upcoming changes to help manage your personal finances and wealth, covering topics from inheritance tax planning to understanding the value of your business interest, onto the use of wills and trusts to protect wealth, and much, much more. So if that is of interest to you, please do scan that QR code that you can see on screen now, and that will register your attendance for the webinar on Thursday. So finally, just a reminder to please complete our very short feedback survey at the end of the webinar so that we can make sure that we continue to improve these webinars and events for you, because we really do value that feedback and we listen to it. So that just leaves me to say that whether you're already a client working with us or not, if anything has come out of today that you'd like to discuss further, please don't hesitate to contact us. We really would be delighted to hear from you. And that just leaves me to say thank you very much for joining us, everyone, and enjoy the rest of your day.